statements about the company which are based on the beliefs, opinions, and expectations of the company as on date of this call. These statements not the guarantees the future performance of the company, and it may involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Dr. B.S. Ajay Kumar, Executive Chairman of Healthcare Global Enterprises Limited. Thank you, and over to you, sir.
Thank you very much, and good morning to everyone. And a warm welcome to the present Q4 and Q24 earnings conference call for Healthcare Global Enterprise. I am joined today by Mr. Raj Gore, our CEO, and Ruby Vitoria, CFO, and my senior management team, along with GA, our investor relations advisor. The past year has been another remarkable chapter in our growth history. We are proud to have positively impacted the lives of those who have entrusted us with their well-being. The achievements have been made possible through efforts and tireless dedication of our doctors, nurses, staff, and other stakeholders. Having spent decades in cancer care industry, both in US and in India, I needless to say there's a stark contrast between the Western countries and India. In the beginning, we used to see a lot of patients with advanced disease. But today, I'm happy to say, in bigger cities, we are seeing patients in early stage, and we are seeing good quality of treatment as well as very good outcome. Given the population of India and more recognition of cancer and lifestyle disease, there is definitely going to be a rising incidence of cancer in the coming decade. With the reported incidence 2.2 million annually, the actual incidence is expected to be much higher, maybe 1.5 to 3 times higher. And the statistics are definitely alarming. At HCG, we are ceaselessly fighting the war against cancer. We are the only organized cancer care chain in the country with a state-of-the-art operation extending to Tier 1 and Tier 2 cities. Thanks to our state-of-the-art technology, including digital PET scans, digital pathology, precision radiation therapy, cutting-edge robotic surgery system, we deliver the highest standard of care to our patients. We recently added Novasic Plus X, which will transform the precision medicine in the era of genomics. We believe precision medicine is the future, targeted therapy is the future, and genomic evaluation is going to play a major role. And having done genomic analysis over several thousand patients, we have certainly become leaders in the targeted therapy based on the genomics. We plan to introduce MR Linac radiation therapy in Bangalore, which will be a notable addition to the vastly superior radiation treatment offering at HCG, which will help us revolutionize radiation therapy in the state. This cutting-edge technology integrates magnetic imaging with linear accelerator to improve the clinical outcome, disease side effects, and reduce treatment span. There are several clinical milestones we have achieved during the year. To mention a few, we have performed record number of minimal access head and neck surgeries in our Center of Excellence in Bangalore. We have administered one of the rare procedures called NeuroSafe, a nerve-sparing prostatectomy. We have done robotic-assisted breast axillothyroidectomy, which is the first of its kind in Mumbai. We have also done significant number of 3D planning, large tumor resection in our Bangalore division, with having an engineering department for the same. We are happy to report that our mortality rate as we measure, or we are one of the few measuring it, has now come under 1% over the years, the feat we are immensely proud of and definitely meeting or beating the global standards. Research and development is an integral part of HCG DNA. Our clinical trials and research initiatives are paving the way for new and improved treatment modalities. We've established an institutional research committee to fund investigator-initiated trials, which is one of a kind in the Indian private health sector. This commitment to R&D nurtures innovation and leads to industry-leading academic excellence in HCG. We continue to collaborate with marquee companies on projects like predictive analysis, analytics, computational work, and clinical design support system by leveraging our AI/ML technology. We have the best-in-class medical talent from around the world, ensuring that our patients benefit from the remains steadfast. We are dedicated to raising awareness, enhancing early detection, and providing advanced treatment options to transform the perception and reality of cancer care and make cancer care a chronic disease. Together, we will continue to strive for better outcome and a brighter future for those affected by this disease. I now hand over the call to our CEO, Mr. Raj Gore, for his observations and strategies going forward, and also the summary of the operational performance for the quarter gone by. Raj?
Thank you, Dr. Ajay. Good morning, everyone. A very warm welcome to all the participants on the call. We are very proud to report a strong performance during Q4/24 with all-time high annual revenues, which grew 12%, with EBITDA growth of 21%, translating to 19% EBITDA margin. This exceptional growth serves as a testament to our enduring commitment to excellence in cancer care. HCG has positioned itself as the destination for cancer care with superior clinical outcomes, underpinned by advanced technology and commanding market-leading oncology business model in India, with robust performance both in metros and non-metros. We continue our dominance in key existing markets like Bangalore, Ahmedabad, and Cuttack, along with turnarounds for centers like Nagpur, Jaipur, Borivali, and now Kolkata. Furthermore, there is a massive potential across the key established and emerging centers that still remain untapped, with potential to grow faster than the market over the next few years, which would help us to improve our return matrix going forward. For the fiscal year 24, ROCE performance for the company has been 10%, whereas our established centers operate at much superior ROCE of 21%. Based on vintages, we see that the nascent centers, although have low or negative ROCE currently, they can significantly improve ROCE to operate in line with longer vintage centers. With the Kolkata center generating positive EBITDA, our conviction on delivering strong returns has only increased. There are multiple levers in place to keep dominating the oncology market in India, which we have captured in the last couple of slides in the first section of our investor presentation. Now, I would like to briefly talk about some of the key strategic initiatives. Over the years, we have taken multiple steps to enhance our operations and improve our profitability. To point out key strategic initiatives during the year, after consistently achieving organic growth for 3-4 years now, we are now poised to expedite HCG's expansion through strategic acquisitions. In addition to our expansion efforts in Indore, we are committed to further strengthen our presence in Bangalore. We are currently in the process of establishing 2 hospitals with total 125 beds in North Bangalore and Whitefield area, slated to be operational in the next 12 to 15 months. These state-of-the-art facilities will enhance our capacity to cater to the growing cancer needs of the region. Furthermore, to enhance the patient experience and streamline access to healthcare services, we have introduced HCG Care Smart App Suite, including a patient app, exclusively designed for unique needs of cancer patients. This innovative platform provides patients with seamless access to treatment options and their medical records with a click anytime from anywhere. In addition, the app would also help us consistently engage with our patients to monitor adherence to treatment plan and post-treatment follow-up to improve long-term outcomes. Already, the Smart App Suite has benefited over 56,000 outpatients with active participation from more than 300 doctors on this digital platform. Our digital revenue has grown 75% year-on-year in FY24 and will continue to be an important driver of growth in future. With this, I hand over to Ms. Ruby, our CFO, for financial highlights.
Good morning, everyone. In reviewing our performance for the quarter, I am pleased to report 12% year-on-year growth, culminating in a top-line figure of 495 crores. For the full year of FY24, the revenue stood at 1,912 crores, witnessing a growth of 13% year-on-year. Our operating metrics, key indicators of our performance, have shown substantial all-round improvement in this quarter. Chemotherapy sessions increased by 15%, OPD footfall rose by 19%, and while our radiation experienced healthy growth, the decline in capacity utilization from 65 to 61 is due to proactive expansion and the incorporation of 4 new linear accelerators. ARPOB for the quarter stood at 42,700 as compared to 39,700, registering a growth of 8% on a YOY basis. The revenue of our established centers experienced an 11% year-on-year growth, and revenue from emerging centers grew by 15% on a YOY basis, with EBITDA for emerging centers growing at 117% on a YOY basis. We are observing a consistent uptake in our emerging centers marked by increased footfall across various cancer treatment modalities. Our 2 prominent emerging centers in Mumbai and Kolkata have demonstrated robust performance. Specifically, our Kolkata center had an impressive year-on-year growth of 20%, while our South Mumbai center achieved 37% growth. Additionally, our Nagpur center has outperformed expectations, recording a remarkable 48% year-on-year growth. On the EBITDA front, our EBITDA grew by 21% YOY and stood at 94 crores for the quarter. PAT for this quarter stood at 21.3 crores as compared to 8 crores in the previous year's same quarter. Our capex for the 12-month period stood at 187 crores, and net debt excluding leases stood at 358 crores as on March 2024. This includes acquisition of Nagpur, Kolkata, and Indore, and we have spent 116 crores towards our growth capex, mainly on our 2 facilities, Ahmedabad and Whitefield. As we speak, Ahmedabad construction is almost complete, and we will be transitioning very soon. We have also given bifurcation of our EBITDA across mature and emerging centers. I would request participants to refer the investor presentation for the further details. With this, I would like to open the floor for question and answers.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask question may press star and 1 on the touchtone telephone. If you wish to remove yourself from question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. First question is from the line of Nishit from Chris Capital. Please go ahead.
Hi, thank you. So I just wanted to ask the revenue growth drivers for FY25 between new beds, ARPOB, and occupancy. Hello.
Hi. If I've understood your question, you're asking about revenue drivers for next year, right? The current year.
Yes, between new bed additions, ARPOB, or occupancy.
Yeah. So look, our volume growth our revenue growth in last few years is primarily driven by 2/3 by volume growth, and it will continue the same trend going forward. It will be largely driven by volume, while we've seen improvement in ARPOB. As you know, during the year we have deployed bed capacity, linear accelerator capacity, OT capacity. We have added clinicians and strengthened our go-to-market efforts. We are also in this year we are moving to a larger facility in our Center of Excellence in Ahmedabad. So we've deployed, additional capacity. We have, increased our clinical bandwidth. We've strengthened our go-to-market, which will continue to help us, get more patient footfalls and therefore grow at a healthy rate, which is better than the market growth rate.
Okay. And, just wanted some color on, outlook on margin for FY25 and beyond. Our EBITDA margin overall for the company in Q4 is around 19%, whereas for FY24 is 17.8%. So is Q4 the new normal for margins, and what will drive margin improvement, if at all?
Yeah, so if I can just take you back, look, first half of the year, we, communicated that, our margins were subdued because investment in clinical bandwidth and then, downtime, transition time to add, our linear accelerators. Throughout this year, subsequently, you have seen improvement in our EBITDA margin. The EBITDA margin that we see in Q4 is on account of better service mix and a payer mix, and operating leverage due to a strong revenue growth. We expect that to continue going forward. And as I mentioned earlier, there are lots of revenue growth levers to drive volume-led revenue growth going forward. Our, utilizations, as Ruby mentioned in her presentation, on beds it's about 56%, on linear accelerators 61%. So I think we are very well poised to drive revenue growth, and that will help us, to get operating leverage. The strongest point, or one of the strongest, performance is, our emerging centers. As you heard, Kolkata has started contributing positive EBITDA. It will continue to grow going forward. South Mumbai has reduced the losses and is expected to, start breaking even sometime in the middle of the year. These two were earlier EBITDA drag due to losses, and now going forward, as they start contributing to the EBITDA margin, we are very confident that we'll continue our EBITDA margin journey in a positive direction going forward.
Understood. So even the emerging EBITDA, which is in Q4 is 14%, you're saying is sustainable, right? Because FY is fiscal year is somewhere close to 9%.
Yeah. So just to recap, we have many centers in this bucket. Most of the centers have been contributing EBITDA and have been growing. The two youngest, hospitals, the Kolkata and South Mumbai, were the drag on our EBITDA margin in the past. Q4, Kolkata in Q3 and Q4 has started contributing positively, and will continue to reduce the losses in South Mumbai and break even in the middle of the year. So as a result, emerging center bucket will start moving, in the right direction throughout this year.
Okay. And could you share how Indore has panned out for us?
Yeah. So look, as we said, Indore was our strategic acquisition in a new market, Madhya Pradesh. Central India has one of the lowest penetration or lowest density of comprehensive cancer care center per million population. It's about 45-50 million population, 45-50 lakh population. You have one cancer care center versus about 16-17 lakh population per cancer care center in our southern region. So we made this acquisition in the second half, starting with the second half. Our first priority was to integrate it on HCG platform in every possible way and invest in this asset to bring it to HCG quality care. We have upgraded, we had started the construction work or renovation work. We've upgraded ICU facilities. We've upgraded private rooms. We have invested in medical equipment, invested in upgrading OT equipment. We have started empaneling, more TPAs. Our go-to-market initiative has been strengthened. It's on the right track so far as per our integration plan, and we'll continue to share the progress going forward. So far, so good in terms of our progress on integration of this new asset.
Got it. So, and any thoughts on inorganic acquisition? Bernard.
Yeah, so we've been saying that after 3-4 years of consolidation and a consistent quarterly performance, strong performance, a few quarters ago we said that we will look at acquisition as a strategic lever to grow or expand the company. We've already done Indore acquisition. At any point of time, we are evaluating, several key assets. And as and when we get to concrete concluding stage, we will be happy to share with everyone.
Okay, thank you. That's all from my side. Thank you.
Thank you. Ladies and gentlemen, you may press star and 1 to ask questions. The next question is from the line of Dhara Patwa from Smiths Limited. Please go ahead.
Thank you for the opportunity and congratulations on the good set of numbers. I just have 3 questions. One is, what is your bed expansion strategy for the next 2-3 years? And suppose if you want to develop a new hospital, so what is your criteria to select the geography for that expansion? Yeah, that's my first question.
Yeah. So thank you for asking that question. Over the years, we have created a dominating presence in our current 18-19 locations. Our first priority is to invest in these assets and create capacity in terms of beds, OTs, linear accelerators. So we continue to dominate our presence and continue to grow our market share in our current locations. We have already announced and shared with you that in Ahmedabad, we are moving from a below 100 beds to 200 bed capacity newly built to our specifications, a very premium advanced cancer care center in next month. So we're doubling our capacity there. We have added, about 20 beds and 2 OTs in last year in our Center of Excellence in Bangalore. We have announced 2 new projects in Bangalore market, one in East Bangalore in Whitefield with 25 beds, a comprehensive cancer care center, and one in North Bangalore, about 100 beds, comprehensive cancer care center, which will become operational in about 12 to 15 months, another 12 to 15 months. So we're doubling down in our both strong markets. In total, across our current hospitals, we are looking at adding about 350 to 400 beds in our existing hospitals in next 4 to 5 years. Most of that will get completed in next 3 years. So that's a plan on our current brownfield expansion in our current markets. As I mentioned that we continue to look at M&A opportunities. In the past, we've had a brilliant track record in acquiring cancer care centers and creating value. So we continue to look at it. We started our journey last year with Indore. We are looking at opportunities. We are looking at, basically our criteria for that is we're looking at, comprehensive cancer care centers in markets which are attractive market in terms of cancer incidence, affordability, household income, density of comprehensive cancer care centers. These assets are usually 70 to 80 beds. We are looking at assets which, preferably are EBITDA accretive from right in the beginning, and we can acquire it at a good valuation. So that's the criteria for our M&A. In markets where we do not see M&A opportunities, but we feel that they are markets of strategic importance, we may look at greenfield, especially in our current states where we dominate, like, Maharashtra, Gujarat. So as and when we have something concrete plan on that front, we'll share with you.
Yes, if I may add, in addition to 350 to 400 beds, we also have about 200 additional installed bed capacity which we have not deployed. So along with adding new capacity, we will also be deploying the existing installed capacity where the capex is already spent.
Yeah. So, if you look at our current occupancy is about around 65%, 67% on our operational beds. Our capacity on capacity beds, including the 200 odd beds Ashu mentioned, which we've not made operational, is about 56%. So we have, in all capacity parameters, we have enough headrooms in our current hospitals to continue to grow for next 5 years.
Sure, sir. This is pretty insightful. My second question was, what is the average life of a Linac machine and the replacement cost for the same?
Sorry, are you asking about average life of a Linac machine?
Yeah, like how much is the duration that we could use it? It is 12 years, 15 years, something like that.
The linear accelerators are normally there for about 14 years, 10 to 14 years. Most of the new technology has been in the software upgradation. The basic hardware platform has remained the same in the last 10 years or so. So as the new technology evolves, as you know, with the AI and high technology, more and more it will be software upgradation. So the basic unit may remain the same with upgradation. So our thinking at this time is it will last anywhere between 12 to 15 years. The average linear accelerator hardware. Of course, the software and all can even last longer, but we are in the transition process as far as the linear accelerator is concerned, because we are talking about adaptive therapy, precision therapy, MR Linac. So many new things are happening, so it is undergoing a tremendous change. And I do believe, as an oncologist, this will last for a long time.
Sure, sir. And lastly, on what will be the effective tax rate for FY25?
Sorry, can you ask that question again?
Effective tax rate for FY25, ETR.
Somewhere between 35 to 39%.
35. Sure, sir. That's it from my side. Thank you.
Thank you. A reminder to all participants, you may press star and 1 to ask question. The next question is from the line of Shyam Srinivasan from Goldman Sachs. Please go ahead.
Good morning. Thank you for taking my question. On the whole, industry, so we have done about 12-13% this year in terms of top line growth. Then I look at some of the large NCR-based players who report oncology separately. They have grown 21 to 25%. I know they may be an outlier, but some of their relative absolute sizes of revenue have now reached almost pretty close to us. So just want to understand what's the reason why we may be actually growing slower than some of these peers? Is it just that they are in expansion phase and we have not, or just want to understand some of the competitive dynamics?
Yeah. So good morning, Shyam. Thank you for that question. We have grown about 12% year on year. However, I want to just point out that last couple of quarters ago, we have announced that we're going to scale down our last shop and shop center in North Bangalore, MSR. So that business has not been with us for last 6 months. If we adjust for that, we have grown about 14% year on year in the last year. That is above the market growth rate, which is about 12%, on an average oncology market. Now, obviously, year-on-year growth rate is also a function of the base that you have. And I think many players, multi-specialty players, have started focusing on oncology recently. And therefore, their year-on-year growth is a function of their existing base that they had. We have a large presence. We've been in this business for a long time, and therefore our base is much higher. Some players have, very high concentration in specific markets, right? So there, the realization plays a larger role in growth versus volume-led growth. I think as a strategy, we want to continue to focus on volume-led growth, which is a sustainable growth, while continue to improve realization, but primarily volume-led growth. Look, as a leading oncology player, we have enough levers to, and enough, we, as explained, our plan is robust to maintain our leadership position, which is volume-led growth, and we will continue on that path. More than that, I can't comment on, other players. Yeah.
While Shyam, as he rightly mentioned, they have been on an expansionary path. We have been in a consolidation phase. We started deploying additional capacities in some of our key centers like Ahmedabad. So Ahmedabad, Cuttack, and some of the other centers, large centers, we have started deploying capital, increasing the capacity, which has been more or less done. And we should start seeing growth momentum from these centers, which will rub on the overall growth of the company as well.
Yeah. Thank you, Ashwin.
Yeah, understood. That's helpful. Just a second question, actually related question to question number one. In terms of doctor attrition, because some of your competitors are expanding, have you seen attrition or any of those parameters that you look at from an HR or a retaining our key talent perspective? Has that seen an uptick or a change, or what are we doing to retain our top talent?
Shyam, as you know, this is Ajay Kumar. As you know, HCG has always been very proud of our doctor group, and our top doctors attrition is very low, less than 5%. So we have been very proud, and even today, because of the way we empower the doctors, we are involved in academics and research, our attrition has not been a major issue, and we don't expect it to be an issue at all. And another thing I want to tell you is we are also in training. We have our own training programs, in fellowship programs, residency programs, and because of that, we have significant number of doctors coming out of the training in medical oncology, radiation, surgical oncology. Because of that, and we are an institution, and I always like to compare it to where I trained MD Anderson. Wherever you went in US, you found doctors trained in MD Anderson. And it is a proud thing that doctors are there working in different institutions trained by that. So similarly, where we go now, we see doctors are trained in HCG are there. So we don't have any issues, doctors who want to even sometimes leave, because we have an internal training mechanism. And because we brand HCG more than doctor, and we collaborate with doctors and work, we don't see that as a foreseeable issue at all. When the people come to it for HCG to HCG as a quality institution, as a destination. So that is how we have been able to grow and maintain our status as the leader, and we will continue to do that. And we are very clear that most of the major doctors have been with us for a long time and will continue to be there, and we don't see any issues in that.
Helpful, sir. Thank you. Just my second question is on, if you could double click on both I think the case studies that you have presented in the investor presentation are very helpful. But I just wanted to go through like South Bombay. What's the, you now are looking at international medical tourism as an avenue. So just want to understand what's the size there. What are the plans for further enhancing our offering at South Bombay? What's been the response even from local patients? That is my second question.
Yeah, so Shyam, as you know, South Mumbai, South Mumbai Hospital is a premium hospital at a very good location. We have a differentiated technology there. It is still the only hospital in Western India with a CyberKnife and tomotherapy under one roof. As mentioned earlier, we have invested in our clinical talent. We have, a medical oncologist who focuses on breast oncology. He used to be director of breast oncology program in UK in Nottingham Hospital. We have a breast surgeon who's come back after getting trained in Memorial Sloan Kettering. So we have a very good talent on medical side, surgical side, radiation. We were always strong in that department. So we have a product now, which is a premium product. Differentiated technology, and clinicians with full-time clinicians with a very high pedigree. I think this is a perfect, and Mumbai is more connected to the rest of the world in most cities in India. So this is a perfect recipe to attract international patients. Just to explain, CyberKnife gives a lot of advantage in terms of treating, cancer patients, which cannot be treated by other modalities, other LINAC machines. But one of the biggest advantage of CyberKnife, when an international patient travels to India, you can treat the patient with a hypofractionation. Generally in linear accelerator, you will go through 25 to 30 fractions, and you have to stay 6 to 8 weeks for that. Whereas CyberKnife can do it in matter of days, and therefore the length of stay for international patients in India becomes much lesser, and therefore out-of-pocket expenses goes down. So not only you have a superior outcome, but your out-of-pocket expenses go down. So we have, it's well positioned to target international patients. We've been working on, our go-to-market efforts in certain markets like Middle East, Oman, and East Africa. We have seen currently 30 to 35% of our center revenue coming from international. At the same time, because of these differentiated products, we are targeting a wider geography, not just South Mumbai, but a greater Mumbai, Maharashtra, and, strategically connected locations to Mumbai, who historically drain into Mumbai, like, Northeast is there, some of the cities in central India. So we continue to spread our net wider in terms of go-to-market to get the right segment for the products that we have in this. We've significantly reduced our losses this year in this center, and we are expecting it to break even sometime middle of this year.
That's helpful, sir. My last two questions, if I may. Sorry, I'm asking many questions, but similarly, if on Borivali, your presentation talks about positive EBITDA in fiscal 24 and revenue going at a CAGR of 22%. So all the changes regarding, I think we have made management changes as well. So how is that seeing fruition now when I look at Borivali? Any numbers you want to share at this point of time, given that we have now reached probably some scale there?
Yeah, so look, Borivali, has been a well-performing asset. Actually, it exactly follows our unit economics. Last year, we have added one more linear accelerator to augment our radiation capacity there. We added robotic, our robot there, surgical robot. We have created a vertical specialization in surgical team. We have onboarded surgical talent. It had shown 20+% growth. It delivers with 20 EBITDA margin, and we have enough spare capacity on all modalities there. So I think we are perfectly poised to gain market share from others and continue to grow at a very aggressive growth rate going forward in Borivali in Mumbai.
Got it. My last question is just on the balance sheet. In terms of our debt, I know debt went up year over year in fiscal 24, but what are the plans going forward? Will we use this dry powder to kind of do M&A like we may have hinted? But just want to understand how should we look at any plans for debt reduction? Thank you.
Hi, thanks for that question. So the current levels we are very comfortable with all our banking covenants. We have enough headroom. We are exploring looking at inorganic growth, and that Raj talked about, and we will be looking at those. In terms of funding requirements for that, we will be funding it through both internal accruals as well as external debt funding.
Thank you and all the best. Thank you.
Thank you. Ladies and gentlemen, you may press star and one to ask questions. The next question is from the line of Ankit Pandya from Incroach Asset Management. Please go ahead.
Hi, good morning, and so congratulations on the great set of numbers. So I have a few questions. So starting with on the capex fund, so what will be the organic capex for the next 1 to 2 years?
So on CapEx, as far as the maintenance CapEx is concerned, we have always guided that our maintenance CapEx will be around 65 to 70 crore. And 70 crore is the number which we saw for the first, for FY24 as well. On the growth CapEx, we have largely any new project which is coming up, we have been presenting it before you. So other than what we have laid out in Ahmedabad and Whitefield in Bangalore, we also announced North Bangalore Center. And North Bangalore, the total capacity is estimated is around 90 crores, which largely would be spent in the current year and a portion of it in the next financial year.
Okay. And sir, you have even mentioned that, in some of the centers you will be adding more capacity over there. So in FY25 and 26, how many brownfield capacity expansion can we expect? Apart from that, the Ahmedabad and the Bangalore that has already been announced.
I think other than Ahmedabad, that's primarily the brownfield capacity increase that will come this year. Rest will probably follow in the year after that. Majority,
we are doing some bed and OT expansion in our existing centers. For example, our center in Vizag, we are doing expansion in Cuttack. So there are bed or associated infrastructure addition which is happening in couple of centers, and large one would probably happen in next financial year in Cuttack.
Okay, so that will be roughly how many beds that will be increasing?
Sorry?
How many beds capacity will be increasing in the brownfield?
That's in Whitefield. In Whitefield, in Bangalore, we are adding about 125 beds.
But that won't come this year. That will be next financial year. So in both projects, between both projects, North Bangalore and Whitefield, will be added about 125 beds, which will get commissioned in the following financial year, FY26.
So, and sir, can you just talk about your inorganic capex also, inorganic plans that you acquisition that you'll be doing? So, which region and how much you'll be willing to invest in inorganic opportunities?
Yeah, so look, I think we are uniquely poised to be a consolidator in this space. There are some active comprehensive cancer care centers across the country. While from a management bandwidth, we would prefer them in existing markets or adjacent to our markets. We will be opportunistic if we get a good acquisition target in a newer state. So, with M&A, you have to be opportunistic. I can't tell you, our investment in these assets will be proportionate to the size of the asset. So, we'll be only able to tell you, as and when we have something concrete. So it's difficult to comment on the size of the acquisition.
Just to address, it will depend on obviously the availability of the capital, and we are mindful of the debt level which we can sustain. And we have our internal guidance on the debt levels. We will be within that.
Right. So one more question on the tax rate. If I look at your cash tax, the tax that you pay on, and it is visible on the cash flow statement. Last year on a PBT of 440 or on a PBT of 45 crores, we paid 22 crores tax, 23 crores tax. That's 50% of PBT. And this year on a PBT of 68 crores, we have paid 47 crores of tax. That's like 70% of our PBT. And then, on the P&L, we are guiding for effective tax rate of 35 to 39%. I thought the corporate India tax rate has fallen to 25% a few years back. So what is it that is keeping our cash tax and our P&L tax so high? 70% tax rate on a cash tax basis seems unreal. So can someone explain to us why our cash tax rate tends to be like 60-70%?
Yeah, sure. So we have various entities and under which our businesses are there. There are entities separately where we incur losses, and since they are separate entities, we don't get that benefit at a consolidated level, and we don't recognize deferred tax asset on that. and that is the reason why our effective tax rate is higher. You're absolutely right that we are moving towards 25% at the corporate level. However, there will be a journey. Once these entities become profitable, we will start seeing a reduction in our effective tax rate.
So I get it. So so on the entities which are profitable, are we paying exactly 25% tax?
Yes, that is right. We are paying 25% tax. So we have about 47 crores of losses that is netting off our overall profitability.
So in other terms, if I calculate...
At the company, we are paying 25%. Sorry, again, please?
Yeah. So what I was asking was that if I take the 47 crores of tax paid in FY24 and I multiply it by 4, that gives me almost 180 crores of profit before tax on our profitable entities. Would that be correct?
So, we have for the year entities making 115 crores of profit, on which we have paid for 24%, which comes 27 crores profit, and we have 47 crores of loss-making entities where there are no tax credits taken. So, if we adjust for the 47 crores, we would be at 27%. Right now, we are at 39% because we are not taking the tax rate of 47 crores. You can do the maths.
No, so I am not following the math here. I'm sorry, I'll have to drill a bit more on this. So 68 crores of consolidated profit, right? Add back 47 crores of losses that you are saying is included in this profit. So that gives me 120 odd crores of profit. Even on 120 odd crores of profit-making entities, we are paying 48 crores of tax. So that's 40% tax. Is that correct?
27 crores of tax. You see the net tax.
Yeah, net of refunds the tax also. No, net of refunds, the tax is 47 crores on your consolidated cash flow. I'm talking about cash tax.
No, please. That includes the TDS also, which is 10%. That is not the tax charge. You should look at the P&L because the balance sheet includes two things. One is the cash tax as well as the TDS, which gets deducted from the payments that we collect from our credit payers. You should not include that.
So what is this TDS? Can you again explain that?
TDS is tax deducted at source under section 194J. Whenever we bill our credit payers, while taking the payment, they will deduct tax at 10% before taking the payment. Or in some places, we have got low TDS, which will be anywhere between 2.5% to 4.5%, but still there is a tax deduction, which normally will get refunded in a cycle of 2 to 3 years. So those are not the cash taxes that does not impact the P&L. That is only a cash flow issue, which is with the government, with the income tax department, which gets refunded after 2 to 3 years.
Okay, I get it. But this has been going on for the last 2-3 years, right? So this 22 crores tax that we paid last year also.
Yeah, so it will go on because we have credit business, which is about 3% of our total revenue. So it will keep going on like that. So once our PAT is 10% of the revenue, you will see negative of that. But right now we are at 2 to 3%, so we have some way to go there.
I get it. Now I understand it. Thank you so much for that clarification. Last question on the multi-specialty hospitals that we have, Raj. This question is for you. On the 3 multi-specialty hospitals that we have, what's the strategy now going forward, and what are the current sort of margins that those facilities are doing for us?
So, Aditya, thank you for that question. We have been pretty clear on our communication on this front. We've had 4 multi-specialty hospitals. Out of that, Bhavnagar is now, oncology is a dominant specialty. We added a linear accelerator a few years ago. We are looking at adding another linear accelerator there. So oncology will continue to contribute more and more in Bhavnagar. Rajkot, again, we are currently, last year we started surgical oncology and medical oncology. Currently, we are in process of building a bunker. So Rajkot will also have a comprehensive cancer care facility, and oncology will become a dominant specialty going forward. In Suchirayu, we are, again, we have a very strong market share there. It's a very good referral center for North Karnataka. We are currently building in bunker for linear accelerator as well as PET scan next to the Suchirayu hospital. Eventually, we have an opportunity. We have another comprehensive cancer care center in Hubli. Eventually, when we need to add more capacity, we cannot add that capacity in our existing Hubli Cancer Center. However, this is a plan, roadmap for going forward. Since we are adding linear accelerator and PET scan next to Suchirayu, we have a growth headroom whenever we need additional capacity, and then oncology will start becoming a dominant specialty within Suchirayu. The last multi-specialty hospital is in Ahmedabad, HMS, which will continue to be a multi-specialty hospital. There is no space there to add oncology in that hospital.
Understood. Thanks, Pat. Thank you, gentlemen. All the best.
Thank you.
The next question is from the line of Vinopati Paravil from Elara Capital. Please go ahead.
Hi, good morning. A couple of questions following up on earlier questions. In Ahmedabad, where we are adding beds, what is the existing capacity utilization there or occupancy there? And what's your expectation regarding the new 100 beds? Is it going to get filled in 6 months?
Yeah, so I wish I can fill 100 beds in 6 months in any market. But yeah, look, Ahmedabad, again, it's a hospital that we started more than 12, 13 years ago. It has less than 100 beds. The capacity constraint, more than beds, it was ICU beds and OTs. We have had 5 OTs. As you know, this is a surgery-dominant cancer center. We have a very strong team of more than 20 surgical oncologists there with vertical specialization and a very high volume, strong robotic surgery center. Since it is a surgery-dominant center, OT capacity and post-op ICU beds became a problem for us or capacity constraint for us, and that's when we decided to invest in a new hospital, which is a 200-bed. There we have, we'll be moving sometime next month. We have to start with, we are doubling the OT capacity from 5 to 10 OTs, and we have a further headroom to add OTs whenever we need. Same for ICU. So we are very excited. This is a center that is built to our specification, very premium center. And, because we have all the clinical bandwidth and currently the number 1 market share, I think we are best poised to ramp it up quickly. How fast can we ramp it? Well, we are shooting as fast as we can. But, as stated earlier, we've always said that we will grow at higher than market growth rate in every micro market. Here we have an opportunity now to increase our market share. We are already number 1 market share with 30+% market share. So we have an opportunity. So we'll go all out and see. It's difficult to predict how fast we can, fill that at this stage.
Can give some historical growth rates around that, right? So in FY23, another center grew by 20%. In FY24, in spite of all the capacity challenges, we grew by 14%. We do expect the growth momentum to continue, and this growth probably will get accelerated once we get into the new centers. We were capacity challenged, and you can take a guidance from here of the growth rate and make a sense of how faster we will fill those beds.
Understood. Thanks for that. And second, typically it takes at least 3 years from plan to operationalizing a new facility or new bed. So after this Bangalore 125 bed addition in FY26, it looks like we don't have a plan to grow further our capacity. Do you have anything in mind, even in early stages, where you'll be doing something significant brownfield or a greenfield for addition beyond FY26?
It's difficult to hear you. Is this question about Bangalore?
No. Overall, your bed growth plan, because we don't have a plan in place beyond FY26. Next year we have 125 bed addition in Bangalore. Beyond that, we don't have a plan in place. So the question.
Yeah, so no, we have a plan. We just spoke about it a little while ago. So let me start from the current base. Today we have 56% utilization on our capacity beds. So we have about 44% beds unoccupied right now in our existing hospitals. So that's number one, first headroom. Then in our strategic markets, like Bangalore, we've added 20 beds, last year. We have we have a plan to add another 25-30 beds in our existing center in next 2 years. We are also adding 2 more hospitals in Bangalore, one in Whitefield and one in North Bangalore, with total 125 beds that will get commissioned in FY26. Now that's enough bed capacity for Bangalore to continue to grow for next 5 years. I would like to point out that we also have 3 daycare centers in this market which have done very well, and will continue to add couple of more daycare centers in next 12-18 months in Bangalore, so that we penetrate. We have a deeper penetration in Greater Bangalore market and grab higher market share. The second key market is Ahmedabad. We just spoke about it, where we are doubling our capacity. So we have a headroom and a runway to continue to grow for next few years. Similarly, market by market, we have added 35 beds in Baroda. We have we are adding another 25-30 beds in Vizag in next year, and then we have a plan to add another 25-30 beds in Vizag in 2 to 3 years. Cuttack will be adding about 60 to 70 beds. Remaining all our hospitals, we have enough current capacity which is unutilized, which will continue to fuel the growth for next 5 years. We don't see any capacity constraint in our hospitals with this plan baked into our 5-year plan. We don't see any capacity constraint for at least next 5 years. And as we ramp up, we will continue to monitor utilization and figure out if we need to add subsequent capacity in any of these markets. So, to summarize, today we have enough capacity to grow. We are clearing the capacity bottleneck, and we'll have a runway to grow for next 5 years. And if we feel that, in next, 2-3 years, we'll continue to monitor it and continue to deploy more capacity in our established centers. These are the centers we have a dominant market share, and we will not let the capacity come between our future growth in future.
So if I can just summarize that, Raj. So you mentioned the 50 addition plus 200 beds additional we have. So we do have visibility within the next 3 years we'll be deploying 500. We also have done an assessment of which are the centers